Is a massive US bailout coming for Argentina? If so, what might it look like? The Argentinian peso has plummeted 99% over the past 10 years, and US Treasury Secretary Scott Bessent just said all options are on the table. How might a bailout actually work? So here we can see the peso has lost 99% of its value over the past decade, and this bleed lower just continues day by day by day. Of course, recently we did a video on Argentina. We're going to recap that very briefly because it is very important for how we find ourselves in the situation. We can see that unlike the US, for example, that runs a very, very large trade deficit, Argentina, to start things off, they actually run a trade surplus and a pretty healthy trade surplus at that. However, due to the fact that they have so much external debt, remember, this means that foreign governments or foreign officials, foreign banks outside of Argentina own the Argentinian debt. Well, that debt has interest. And so what that means is that Argentina must be sending money, those interest payments, out of their country. So we shouldn't necessarily look at the trade balance, which is, again, quite strong, trade surplus. We need to look at the current account because, of course, primary and secondary income, they don't matter as much for a country like the US, where the current account is basically the same as the balance of trade. But for a country with high external debt, the current account actually reflects the true situation much better than the trade balance, which, again, indicates that Argentina's in pretty healthy shape with a good trade surplus. Well, they actually run a current account deficit as of the most recent data. Now, the last annual print that we got for 2024, they had just ticked into positive territory of about 0.5% current account as a share of GDP. But we can see that they have struggled with a large current account deficit. This has been dragging their financial situation down because, again, the current account is reflecting those overall capital flows when it comes to trade and, of course, primary and secondary income. To make matters worse, they also have run a very large government budget deficit, meaning the government has spent more money than is collected in tax revenue. And we can see that budget deficit was at its peak 8.5% of GDP. The US right now is about 7% of GDP, which is already crazy. And the US is the reserve currency issuer of the world. So Argentina's twin deficit here of both a current account deficit, again, as of the most recent data, going back to 2008, they have basically run a persistent current account deficit. And again, to make matters worse, there's also a fiscal deficit where the government is spending more than they're collecting. However, they have been able to turn around the fiscal side. So this, by the way, the white line, this is why you need to adjust for a failing denominator. If you look at it in Argentinian peso terms, it looks like their budget surplus, which Milei was able to achieve, it looks like they are just blowing it out of the water. However, once you adjust for the collapse of the currency and look at it as a share of GDP or maybe in dollar terms, you can see it's much more tame. But it is worth pointing out, Milei was able to turn, a persistent budget deficit into a surplus. This is, one area was where he was actually successful. Right now, running at about 2%. As a share of GDP. However, Argentina has been struggling with hyperinflation. Here we can see the inflation rate in 2024 peaked out at 300%. Now, they have had disinflation, meaning the rate of inflation has come down to just a meager 33% annual rate of inflation. But this is yet another a struggle for Argentina. GDP, on the other hand, again, Milei, one area where he has, outside of the fiscal budget, where he has gotten some success, he has been able to turn, relatively poor GDP when he took office. He has been able to turn that GDP positive and grow the economy. Right now, running at about 6.4%. And again, inflation's running at 39% annual rate of inflation. So nominal growth would be, almost 50%. And so when we get to the bond market, just keep that in mind. Now, unemployment has ticked up from when he took office back here. Unemployment was 5.5%. It has ticked up to 7.5%. So there's one negative. Now, of course, bailouts. Everyone is talking about doing whatever is necessary to save Argentina. All options are on the table. A liquidity bazooka might be coming from the US. They talk about these options: swap lines, direct currency purchases, where the US government would be purchasing the Argentinian peso to boost the value of the peso, and purchases of dollar denominated government debt from the Treasury's ESF, or Exchange Stabilization Fund. Now, if you don't know what that is, don't worry. That is what the point of the video is. We're going to get into the ESF, how that functions. We're also going to talk about swap lines, which are another option for the U.S. bailout. Could be via the form of swap line, which, again, if you're not familiar with that concept, we will get into how that works. I will also link these various articles from Reuters and whatever the one was before. I will link those in the description. Here, by the way, Scott Bessent's own words: Argentina is a systemically important U.S. ally. Systemically important. That's pretty strong language. And the U.S. Treasury stands ready to do what is needed within its mandate to support Argentina. All options for stabilization are on the table. So are we about to see a liquidity bazooka? And if so, how would it actually work mechanically? Is this a bailout at the taxpayer expense? We'll get into all of these very wonky concepts like the ESF, and a swap line will tell you how exactly those work in simple English in a second. Here we're going to look at foreign exchange reserves. So theoretically, these have been drawn down over the past couple months as they've sought to stabilize their currency. But remember, foreign exchange reserves are basically national savings. Assume that Argentina runs a current account and a trade surplus with the US. Well, what that means is that more dollars are flowing into Argentina than Argentinian pesos are flowing out. So on a net basis, they are saving and accumulating savings. Well, those national savings are called foreign exchange reserves. And we can see that during periods of time where there is a current account surplus, they are able to accumulate national savings in the form of foreign exchange reserves. You can think of this as national savings. However, when the current account dips negative, we can see that draws down on their foreign exchange reserves. Remember, your people need medicine. They need autos, cars. They need food. Whatever you are importing is critical to the health and well-being of your people and your economy. So you must finance it somehow. Well, they weren't running a fiscal surplus back here. They were running a very large fiscal deficit. So one of the main ways that you actually pay for all those imports, because again, you're not bringing in enough money from selling goods to the rest of the world, so you have to draw down on your foreign exchange reserves. But theoretically, again, this is technically about $1.5 billion lower than it shows here. But technically, they have $31 billion of foreign exchange reserves. What that means is that if they really wanted to, they could draw down on those foreign exchange reserves. They could purchase $32 billion of Argentinian pesos, or $32 billion of US dollar denominated bonds. Now, that'll be an important point in a second. Here we can see the stock market, which has declined 40% over the past year or so. Now, recently, Milei is a very libertarian sort of guy, came in with the shock therapy of cutting spending and austerity. His general party, which represents that kind of fiscal responsibility and so forth, that party lost pretty severely in a local election or provincial election recently. And so this has boosted fears that the kind of profligate spending and large deficits and irresponsible sort of money printing that had plagued Argentina for so many years, that'll make a return. So we've seen a sell-off in the stock market. We've seen a sell-off in the currency, and we have also, of course, the currency has been moving lower regardless. And, of course, we saw a sell-off in the dollar-denominated bonds. So Argentina's had 9 bailouts. We won't go through every single one of them, but suffice to say, one of the many kind of debt restructuring schemes that Argentina is engaged with is issuing dollar-denominated bonds. Here we can see the dollar price, the underlying dollar price of those bonds. Remember, the bond price is inverse to the yield. And I've put an approximate interest rate for the various maturities. We can see it's an inverted yield curve with higher interest rates at the short end of the yield curve in the notes section in the belly of the curve than it is further out. This reflects heightened uncertainty over the near term, and therefore a higher premium is being demanded with those shorter maturities. Well, the problem here is these are dollar denominated bonds. What that means is the interest is dollar denominated. Well, we established what the currency is doing. So what if the Argentinian peso is weakening? The other way of thinking about that is that the dollar is strengthening relative to their currency. Well, what this does, if you're issuing dollar denominated debt in an effort to attract foreign investors and signal responsibility, well, as your currency weakens, all of those dollar denominated bonds, your dollar denominated debt actually grows larger. The debt burden becomes worse as your currency, the Argentinian peso, weakens, or again, put another way, the dollar strengthens. So this is one of the main reasons that they are in so much trouble, is that their currency is just plummeting in value, and they're constantly having to dip into their foreign exchange reserves in an effort to bid up their own currency, to basically liquidate dollars to buy Argentinian pesos. Hopefully that makes sense. Again, that was not the most recent data. Reports are that they've drawn this down to about 30 billion US dollars. But again, technically, what that means is that they have at their disposal $30 billion to buy of their own currency, or sell 30 billion of dollars to buy 30 billion of pesos. And again, the dollar denominated debt is why this is a problem. Dollar denominated interest, well, that dollar is strengthening versus their currency, making the debt burden worse. Here we can see the exchange stabilization fund. So this is one of the three options for the bailout that we're going to go into, is what is called the ESF. And I will link to this in the description. This is from the Treasury website. This talks about how the ESF works, but don't worry, we will go through it here in this video as well. We'll also talk about swap lines and how those actually work. And we'll also talk about, is the U.S. taxpayer going to be bailing out the Argentinian government? Because that is a question on everyone's mind, of course. There's political points being made. There's Secretary Warren, for example, is very, very vocal coming out against this, what she calls bailout. We'll look at how it actually is funded and whether or not money printing would be happening in the U.S. Here, by the way, we can see Exchange Stabilization Fund via the SDR, and we'll get into what SDRs are. And you can read through this and see the history of other quote-unquote bailouts via at least the SDR mechanism or lever. You can see that Ukraine is a common appearance here on that, at least on the ESF when it comes to SDRs. So to start with, what is a swap line? So a swap line is basically an agreement between two governments that you will be able to exchange or swap one currency for another. So there are permanent standing swap lines with, of course, close allies like the Bank of Canada, the European Central Bank, Bank of Japan, Bank of England, the Swiss National Bank. But we do not in the U.S. have a standing swap line with Argentina. However, it's important to point out from a geopolitical standpoint that Argentina does have a swap line with China. I believe it's 10 billion yuan in terms of a swap line with China. So from that geopolitical side, if the U.S. is trying to gain influence, we should, at least in the eyes of the government and policymakers, we should be extending a swap line. Well, how this works is that temporarily, for a short period of time, usually under 90 days, and with interest, depending on whatever the overnight interest rate is, plus a spread, usually small spread of half of a basis point, dollars are printed electronically, again, similar to QE. The Fed increases, the Fed, which is the U.S. Central Bank, increases its liability, which is the dollar deposit, and then assets also are increased by a similar amount, because remember, you're swapping one currency for another. So how this works, just kind of step by step, the Fed credits, say, $10 billion to the Argentinian Central Bank. They just send it electronically. Argentinian Central Bank, now you got $10 billion you didn't have yesterday. The Argentinian Central Bank sends the equivalent, whatever the exchange rate is. When I calculated it, it would have been 13.6 trillion pesos. Well, Argentinian Central Bank sends that to the Fed. That is based on the current exchange rate. Argentina now has $10 billion to use for domestic liquidity needs. And again, if they're facing dollar liquidity shortages, this could be a lifeline for them. And the Fed, the US government, has Argentinian pesos as collateral. For again, it's a short term swap, usually under 90 days. At the end of the term, usually about 3 months later or within 3 months, the Argentinian central bank will repay the US that 10 billion US dollars plus interest, and that'll get credited to the Fed. And then, of course, the Fed sends back to Argentina the 13.6 trillion Argentinian pesos. And if you're thinking, well, what about FX risk? There is no FX risk for the Fed. There is no foreign exchange currency risk for the Federal Reserve, because it could, though it could hold the foreign currency if unpaid, but defaults are rare. Generally, there is basically, you can think of it as no foreign exchange risk for the Fed, generally speaking. Again, defaults are pretty rare when it comes to swap lines. Now, the other option is what is known as the Exchange Stabilization Fund. Here is the balance sheet for the Exchange Stabilization Fund, and we can see that the total net position is about 219 billion US dollars. This is basically a slush fund for the US Treasury that it really doesn't have much oversight. So here we're going to talk about the ESF. This is one of the ways that we could see a bailout. So the ESF, or the Exchange Stabilization Fund, is a reserve fund. It's a pool of assets like dollars, foreign currencies, SDRs, which we'll get into next, gold certificates. Is controlled by the U.S. Treasury Secretary. Currently, that guy, Scott Bessent, that said all options are on the table. And the goal of it, or the point of it, is to stabilize the U.S. dollar in global FX markets. But it can also provide short-term aid to foreign countries or intervene in other countries' currency crises like we're seeing in Argentina. So it can buy or sell foreign currencies. That is FX intervention. Most central banks around the world do this. Extend short-term loans to foreign governments. So we could extend a dollar loan to the Argentinian government. That would come out of the ESF. Or we could purchase foreign bonds. Remember those dollar-denominated bonds? Well, maybe from the ESF, you could buy some of those bonds, which would decrease the interest rate, right? Remember, boost the bond value, decrease the interest rate. Or within the ESF, there are these special drawing rights, which again, we'll get into in the next slide. Anything for a foreign loan over $5 billion or for a long-term basis does need presidential approval. Now, there's no annual budget from Congress. I said this is basically a slush fund with no oversight. There's no annual budget from Congress. Earnings that the fund, the ESF, accumulates are from holding treasuries, holding foreign bonds, holding currencies, again, via interest or foreign currency exchange gains, right? If the currency is strengthening versus a dollar, that would be a gain for the ESF. And then also these SDRs. And again, we'll get into this in a second, but when the IMF allocates SDRs, the ESF is who issues those SDR certificates to the Fed and crediting an equivalent amount of US dollars to its account. We can also borrow short-term from the Fed via this ESF or the Treasury General account by issuing special notes that are generally not interest-bearing. The ESF accounts, this Exchange Stabilization Fund, is based out of the New York Fed. Now, the New York Fed is the main kind of market operator when it comes to the Federal Reserve. That is the branch of the Fed that engages in these sorts of open market sort of activities. It is the New York Fed. And so that is where the ESF accounts are based out of. And the transactions are balance sheet adjustments. No actual new money. Generally speaking, no new money is being printed, generally speaking. There are rare cases where you could see actual money printing. So the steps for how this would work: the Treasury Secretary decides, hey, we're going to purchase some Argentinian dollar denominated bonds. The ESF then uses either existing US dollar cash holdings. We do have dollars in the ESF. If available, these would come from past profits. Again, like all the way back in the 1930s, when we revalued gold up, those dollars are that gain was captured via the ESF. Interest earned on investments. Again, if the ESF owns foreign bonds, it is receiving interest. So that is a gain for the ESF, and also returns from prior operation. So if they're trading and they make a decent trade and the currency appreciates, well, that is a gain for the ESF. So that is basically where the funding would come from. And we looked at the balance sheet here. Again, I will link to this balance sheet that shows about $219 billion in terms of the overall net on the balance sheet. So they have these $219 billion that, again, are outside of congressional oversight. It's basically a slush fund for the U.S. Treasury. If more dollars are needed, now I don't think the bailout would go, $500 billion. We don't think it would be that large. But if more US dollars are needed, the ESF can also sell some of its assets, right? If it doesn't have enough dollars sitting in the ESF, it could sell some of the foreign currencies that it has. It could sell some of the treasury bonds that it owns. And of course, now they would have dollars, and then those dollars could be used to purchase the dollar-denominated bonds. Another way is by issuing these SDR certificates. And again, we'll talk about SDRs in the next slide. All of this happens electronically via the Federal Reserve System or the IMF. So here is SDRs. This is yet another wonky concept, but this is how the bailout might function, so it's important to understand. Here we're looking at special drawing rights. These are basically certificates that represent a claim on hard currency, is what they call it. Currencies like the dollar, the euro, the yen, strong currencies, not emerging market currencies. They're basically synthetic international reserves. It's quite difficult to actually describe it much better than that. These were basically created out of thin air by the IMF and then credited to various countries depending on their size. So we could see the dollar, this basket of currencies on which the SDR is valued. It's kind of like the DXY. You can think of it that way. The dollar is about 43%. So each country gets this SDR, and it's basically an IOU or a claim on these currencies, the dollar, the euro, the yen, strong currencies. And the way that the SDR is valued is based on how's the dollar doing. I mean, that's half of the value right there. How is the euro doing? That's a third of the value right there. So that is how the SDRs kind of fluctuate in terms of value. These SDRs are printed out of thin air by the IMF and then credited to all 190 IMF countries based on their size. So the US, obviously, with the largest GDP, we get the majority of the SDRs whenever there is a new allocation. And again, these act as an official reserve asset. You can think of it as kind of digital gold that just gets printed out of thin air by the IMF. And really all it represents is a claim on the dollar, the euro, the yen, relatively strong developed market currencies. Now, if a country holds more SDRs than their allocation, they actually earn a small amount of interest, and that's based on global interest rates. If they hold less than the allocation, they actually pay interest rates. So there's a bit of an incentive to be responsible with their SDRs. Now, when a country like Argentina, if they need to use their SDRs, and they do have some, they contact an IMF partner. In this case, with the U.S. bailout, we'll assume it's the U.S. They contact the U.S. and they say, hey, we have these SDRs, and of course, they fluctuate in value, and they're based off of mainly your dollar, and they are worth X amount. We would like to transfer them to you in the U.S. We want you to hold them, and in exchange, we want to receive from you dollars. So we are sending basically collateral. These SDRs are worth actual money. And again, the value fluctuates based on the dollar, the euro, the yen. They have real value, at least within the system. The IMF and various participants, they have real value to the participants because again, they represent a claim on small portion dollar, euro, yen, these developed market currencies. So they have an inherent value that can act as collateral. They send those to the U.S., and in exchange, the U.S. sends them dollars, which again, they can use to buy back maybe some of their bonds to boost the bond value, maybe to pay some of the interest expense, maybe to finance a trade deficit, whatever they need to use the dollars for. They can do it because they're sending to the U.S. their SDRs, which again are kind of synthetic reserve assets, collateral, you can think of it. And the U.S. is sending dollars to Argentina. The ESF is who handles these special drawing rights. So anytime there's a transfer between, say, the US and a country like Argentina, it is that exchange stabilization fund, again, that kind of opaque slush fund that the Treasury runs. It is the ESF that handles special drawing rights, and effectively these are backed by or pulled from the Treasury general account. So no new money is actually created when the ESF is engaging with various SDR transactions. Now, in 2021, the IMF allocated about, in total, all over the world, about $650 billion in SDRs. Argentina only received about 4.3 billion because remember, it's based on your size. So, Argentina, the way you can think of this is one day in 2021, Argentina just woke up $4.3 billion richer. That is essentially all that really happened in a practical sense of the term. They just woke up one day with these SDRs, these synthetic reserve assets, credited to an account. And again, they represent a real thing, which is a claim on the dollar, the euro, the yen, the Swiss franc, I believe. So they have a real value, and they just got credited to all the accounts of the IMF participants. And then, of course, in 2021, it quickly exchanged the SDRs for dollars because it had to repay its debts and boost its central bank reserves due to hyperinflation. So that was the foreign exchange reserves that we were looking at earlier. Now, here, by the way, is the chart that we're looking at here is the level of SDRs for the Federal Reserve. As of Wednesday, for the US, we currently have about 15.2 billion US dollars worth of these special drawing rights. And again, we get the most. Every time there's an allocation, we get the most of this kind of synthetic global collateral because, of course, the US has the largest economy. So special drawing rights, or these SDRs, are yet another way that the bailout could happen. Argentina could send SDRs to the US, who in exchange would send them dollars. And on a net basis, theoretically, this should not result in any real money creation, as it's a one-to-one sort of swap. The SDR is just being cashed in. You can think of it like a gift card that is being cashed in for the actual dollars. I kept saying, the SDR is backed by real thing, which is dollars, euros, yen, some amount of real value. Well, basically, it's just a receipt or gift card, or however you want to think of it, that can be cashed in for real dollars when you actually need them, for real euros when you actually need them, depending on your situation. For Argentina, of course, the dollar-denominated debt is their biggest concern, so they would likely cash in the SDRs, and in exchange, the U.S., our SDR balance would go up. And so on a net basis, it shouldn't create any net reduction or increase in terms of the money supply. So that's how the bailout could work. We still don't really know how it's going to work, but most likely it's going to be either the ESF, the swap lines, which we went over. This is where the currency is being swapped one for one. So the U.S. is getting some pesos as collateral, and while Argentina is working to repay the loan, it's a short-term thing. We are holding the pesos, and in exchange, they got dollars. At the end of the term, they will send back and repay the loan, and we will send them back their pesos. We'll get the dollars back on a net basis. There was no actual new money creation. Now, there can be, if there's a default. Theoretically, it is possible for money creation to be to occur. And here, by the way, we can see the central liquidity swap lines for the Fed and the balance of those going back to 2019. You can see periodically there are crises or liquidity needs all over the world, and so the Fed will extend a swap line to a country. Now, of course, there are standing swap lines with major countries, major allies like Canada, Europe, Bank of Japan, Bank of England, those sorts of countries. But we can also extend swap lines to countries like Argentina. So that is one way it might work. And then, of course, again, via the Exchange Stabilization Fund, possibly via these SDRs, that is the other way that we could likely see some sort of foreign exchange intervention where via the ESF, and again, I will link in the description to the Treasury's own website that has the balance sheet and all of that, so you can read on your own. But via this ESF, we would be actually purchasing Argentinian pesos. We would be purchasing maybe dollar denominated bonds. And that would happen via the ESF. And of course, special drawing rights, which are these IMF synthetic certificates or reserve assets, these are also handled by the ESF. So we don't know what the bailout looks like. It's going to be one of those three things. And so now you know, hopefully at least a little bit more than you knew before this video about how these sorts of bailouts actually work. So hopefully that was helpful, and I'll catch you in the next one.